Picture this. It's 1995, and one man just reported the single largest tax loss in American history. $916 million in a single year. His casinos were bankrupt. His yacht seized. His helicopter gone. The New York Post called him, "Uh-oh," mocking his nearly billion-dollar debt. Wall Street bankers literally put him on a $450,000 monthly allowance, like a child with a credit card problem. This wasn't just financial failure. This was a public execution of a reputation. But here's what nobody saw coming. That catastrophic loss wasn't the end of his empire. It was the beginning of one of the most controversial comeback stories in American business history. Because that $916 million disaster became a tax shield so powerful, it potentially allowed him to avoid paying federal income taxes for nearly 2 decades, all completely legal. While he was being mocked on tabloid covers, he was actually deploying a strategy that would rewrite his entire financial future. This is the story of how Donald Trump turned his most humiliating moment into his greatest financial advantage. And the lessons hidden in this tale reveal something profound about leverage, brand, and the American tax system that every entrepreneur needs to understand. If you're fascinated by the hidden economic stories that shaped our world, the ones that happened while most people weren't paying attention, then you're in the right place. Hit that like button and subscribe to The Sleeping Economist, because we're diving deep into the financial mysteries that changed everything. Chapter 1. The Golden Tower starts to crack. To understand Trump's 1990s crisis, you need to understand the 1980s boom that preceded it. Donald Trump wasn't just a real estate developer, he was the face of American excess. Gold towers, private jets, yacht parties. His 1987 book, The Art of the Deal, became a bestseller, cementing his image as a billionaire mogul who could sell anything. But beneath the gilded surface, a time bomb was ticking. Between 1985 and 1994, IRS records would later reveal that Trump's businesses lost $1.17 billion more than any other American taxpayer during that period. We're talking $46.1 million in losses in 1985 alone, escalating to over $250 million by 1990. These weren't just bad years. This was a systematic collapse. The epicenter was Atlantic City. In 1990, Trump opened the Taj Mahal Casino, calling it the 8th wonder of the world. He spent nearly $1 billion building it far over budget. To finance the construction and purchase, he issued $675 million in junk bonds with a crushing 14% interest rate. Think about that. He needed to generate approximately $94 million per year just to pay the interest on those bonds alone, before covering any other operational costs. The math never worked. The Taj Mahal opened on April 2, 1990, with enormous fanfare. By November of that same year, just 7 months later, it filed for bankruptcy protection. The casino couldn't generate anywhere near the revenue needed to service its massive debt. Trump wasn't just losing money on one property. He owned 3 Atlantic City casinos that together carried about $1.3 billion in debt. But the casino catastrophe was just one piece of the wreckage. Trump's personal spending was equally unsustainable. His lifestyle required millions per month to maintain. He owned the Plaza Hotel in Manhattan, purchased for $407 million, another highly leveraged deal, drowning in debt. He owned Trump Tower, Trump Plaza, an airline called the Trump Shuttle that was bleeding cash, a massive yacht, and multiple helicopters. By June 1990, Trump couldn't make a $43 million bond payment on his Taj Mahal casino. The banks faced a choice: let Trump collapse entirely, which would mean massive losses for them, as his assets were liquidated at fire sale prices, or restructure his debt and hope he could survive. They chose survival barely. The banks put Trump on a $450,000 monthly personal allowance to control his spending. They took control of his business operations. They forced him to sell assets. His airline went to U.S. Airways. His yacht, named the Trump Princess, was surrendered to creditors. It was, by any measure, a controlled demolition of an empire. Chapter 2. How Debt Becomes a Prison. The early 1990s were what Trump would later call his zombie years, financially dead but still walking. By 1992, his personal debt exceeded $900 million, while his business entities owed billions more. The banks essentially owned him. Every major business decision required their approval. Trump's legendary deal-making ability was now handcuffed by committees of nervous bankers who'd already lost hundreds of millions on his ventures. The Plaza Hotel deal in 1992 illustrates just how controlled he'd become. Trump was forced to hand over 49% of his interest in the landmark Manhattan Hotel to a consortium of banks led by Citibank. In exchange, the banks lowered his interest payments and gave him breathing room. It wasn't a negotiation. It was a surrender dressed up with a press release. Meanwhile, his other Atlantic City casinos were cannibalizing each other. Trump Plaza, Trump Castle, and the Taj Mahal were all competing for the same pool of gamblers. Industry experts call this market saturation. Instead of expanding his empire, Trump had essentially built three competing businesses that undermined each other's profitability. His casino empire was losing tens of millions annually. The psychological toll was immense. Trump had built his entire identity around being a winner, a billionaire, a titan of industry. Now, newspapers ran stories about his debt. Comedians mocked him. Business rivals whispered that he was finished. His marriage to Ivana Trump ended in a spectacularly public 1991 divorce that dominated tabloids. But something fascinating was happening behind the scenes. Trump's attorneys and accountants were working the system in ways that would become clear only years later. Every loss, every failed deal, every bankruptcy, all of it was being meticulously documented and aggregated. Under U.S. tax law, when a business loses more money than it makes, it can claim what's called a net operating loss, or NOL. This loss doesn't just disappear. It can be carried forward to offset future income. Essentially, if you lose $100 million 1 year, you can use that loss to reduce your taxable income in future profitable years, potentially paying zero taxes until you've used up that loss. By 1995, all those years of spectacular failure had accumulated into something unprecedented, a mountain of losses totaling $916 million that Trump could carry forward on his personal tax returns. This wasn't some loophole he discovered. Net operating loss deductions are a legitimate, normal part of the tax code designed to smooth out business cycles and prevent companies from being destroyed by temporary downturns. But Trump's losses were so massive, representing nearly 2% of all NOL deductions claimed in America that year, that they created an extraordinary tax shield. If he could generate $50 million in income annually, he could potentially pay zero federal income taxes for up to 18 years. The question was, could a man whose businesses had lost over $1 billion ever actually generate taxable income again? Chapter 3. The $916 million Declaration. The year 1995 marked the inflection point. Trump was still deep in debt, still controlled by banks, still the subject of whatever happened to ... double quotes articles in business magazines. But this was also the year he made two crucial moves that would define his comeback strategy. First, in June 1995, Trump took his casino operations public, creating Trump Hotels and Casino Resorts, THCR. Through an initial public offering on the New York Stock Exchange, the company raised $140 million by selling stock to public investors. Additionally, he sold $155 million in junk bonds. Trump personally controlled the company and collected $51 million in cash plus $11 million in stock in exchange for assets, mainly land, that he transferred to the new public company. This was financial engineering at its finest. Trump essentially used other people's money, public shareholders and bondholders, to pay down some of his personal debts while maintaining control of the operations. He converted his privately held casino liabilities into a publicly traded company, spreading the risk to thousands of shareholders. It was like refinancing a drowning company by finding new investors who didn't fully understand how deep the water was. Second, and most significantly for our story, Trump's 1995 tax return declared that $916 million net operating loss. Those 3 pages of his state tax returns, which were leaked to the New York Times in 2016, showed the full magnitude of accumulated losses. The document revealed losses from businesses, including his casinos, hotels, and other real estate ventures, alongside something labeled Partnership S Corporation Income accounting structures that allowed business losses to flow through to his personal tax return. Tax experts who examined the documents confirmed this loss could legally allow Trump to avoid paying federal income taxes for years, possibly decades, depending on his future income. At the time in 1995, no rules allowed losses to be carried back 3 years and forward up to 15 years. For someone generating $50 to $60 million annually in taxable income, that $916 million loss was a golden ticket to tax-free living. Critics called it a scandal. Trump defenders called it genius. But both sides agreed on the legality. Nothing about claiming an NOL is illegal or even unusual. Thousands of businesses use this provision every year. What was unusual was the sheer scale losses so massive they nearly broke the measuring stick. The breaking point wasn't the loss itself. It was the realization that Trump had turned catastrophic failure into structural advantage. He'd weaponized bankruptcy. While the public saw humiliation, Trump's accountants saw opportunity. The man who'd lost more money than anyone in America now had the tax system's permission to keep virtually every dollar he'd earn for the next 2 decades. Chapter 4. The Art of the Comeback. The immediate fallout from Trump's 1990s financial crisis didn't look like recovery. It looked like damage control. By 1996, his newly public casino company was already struggling. Shareholders who'd invested in the 1995 IPO watched as the stock price began a slow descent. By the end of 1996, Trump hotels and casino resorts carried $1.7 billion in debt. Much of it the old Trump casino debt that had been transferred into the public company structure. The company lost $647 million between 1995 and 2004. If you'd invested $100 in Trump's company during the IPO, you'd have lost more than 90% of your investment over the next decade. The company would eventually file for bankruptcy in 2004 and again in 2009, and yet again in 2014. Public shareholders got wiped out. Bondholders took massive losses. But here's the twist that defines Trump's strategy. While the public company hemorrhaged money and investors lost fortunes, Trump personally extracted millions in salary, bonuses, and fees. Even as Trump hotels and casino resorts lost money year after year, Trump collected an annual salary of approximately $2 million, plus consulting fees and licensing payments for the use of his name. This is where the lesson becomes clear. Trump had shifted his business model from ownership to brand licensing. He didn't need to own successful casinos. He just needed the Trump name to maintain enough prestige that other entities would pay him to use it. The public company's performance was almost irrelevant to Trump's personal cash flow. He'd essentially insulated himself from the consequences of failure. Meanwhile, that $916 million null shield was doing its job. Tax records later obtained by journalists confirmed that Trump paid 0 federal income taxes in multiple years following 1995, including 2000, 2001, 2002, 2003, 2004, and several others. The exact years varied, but the pattern was clear. While earning millions annually, his taxable income remained zero or negative thanks to his carried forward losses. The public mocked him. Business schools taught his casinos as case studies in failure. Creditors cursed his name. But Trump kept appearing at high-profile events, kept giving interviews about his wealth, kept his name on towers and properties worldwide. The brand survived even when the underlying businesses didn't. By the late 1990s and early 2000s, something remarkable was happening. The general public was forgetting about Trump's disasters. A new generation of Americans knew him only as that rich guy from New York with buildings everywhere. The losses faded from collective memory. The myth of the billionaire mogul was being reconstructed, brick by carefully placed brick. The stage was being set for the greatest comeback of all, one that would turn a failed casino developer into one of the most recognizable brands on earth. Chapter 5: The Apprentice and the Brand Resurrection. Everything changed in 2004 when a British television producer named Mark Burnett pitched Trump a reality show concept. The show would be called The Apprentice, and it would feature aspiring entrepreneurs competing for a job in Trump's organization. Trump would play the decisive boss, presiding over boardroom eliminations and delivering his catchphrase, "You're fired." The show premiered on January 8, 2004 on NBC and became an immediate cultural phenomenon. At its peak, The Apprentice drew more than 20 million viewers per episode. It was appointment television. Suddenly, Trump wasn't the guy whose casinos went bankrupt. He was the sharp-suited billionaire mentor teaching America about business success. The financial impact was staggering. Tax records later revealed that Trump earned $427.4 million from The Apprentice over 14 seasons. From 2004 through 2018, this included approximately $197 million directly from the yacht show and another $230 million from licensing deals that the show's fame generated. Think about the mathematics. Trump's business losses were being erased by entertainment income. The Null Shield meant much of this apprentice money could flow to him tax-free for years. He was essentially being paid hundreds of millions of dollars to play a successful billionaire on television, while his actual tax liability was dramatically reduced by his historical business failures. The licensing deals were the real gold mine. Trump discovered he could earn enormous fees by simply allowing developers to put his name on buildings, even properties he didn't own, develop, or finance. Trump Tower Manila, Trump International Hotel Toronto, Trump Soho, Trump Ocean Resort Baja. These projects and dozens more paid Trump millions in licensing fees for brand association. Some of these licensed projects succeeded. Many failed spectacularly, leaving buyers and investors burned while Trump walked away with his licensing fees already secured. The Trump Ocean Resort in Baja, Mexico, for example, collapsed before completion, costing buyers their deposits, while Trump claimed he was merely a licenser, not the developer. But the public perception had shifted. The Apprentice rehabilitated Trump's image so completely that most Americans had no idea about his string of business failures. They saw only the television character, the decisive leader, the business genius, the boardroom commander. The myth and reality had completely diverged. By 2015, when Trump announced his presidential campaign, he could credibly claim business success to millions of voters who'd grown up watching The Apprentice. His tax returns, which he refused to release during the campaign, remained a mystery. The $916 million loss wouldn't become public knowledge until the New York Times reported it in October 2016, just weeks before the election. By then, the comeback was complete. Trump had converted catastrophic losses into political power. The public company's shareholders and casino bondholders who'd lost fortunes were forgotten. The tax years with zero federal income tax liability were hidden. What remained was the brand, the image, The myth all polished to a gleam by 14 seasons of reality television. Chapter 6. What this teaches us about leverage, failure, and the system. So what's the real lesson in this extraordinary financial saga? It's not avoid paying taxes or file for bankruptcy. The deeper truth is about the nature of leverage, not just financial leverage, but strategic leverage of reputation, legal structures, and societal perception. First, understand net operating losses. The tax code allows null deductions because business is inherently risky. If entrepreneurs faced full taxation in profitable years but received no relief for lost years, fewer people would take business risks. The system is designed to encourage investment and entrepreneurship by smoothing out the taxation across good and bad years. The controversy isn't about legality. It's about fairness and inequality. A wage earner who loses their job can't carry forward that lost income to avoid taxes when they're employed again. But business owners and investors have access to sophisticated strategies that can dramatically reduce tax liability legally. Second, recognize the power of brand separation. Trump's genius, if we can call it that, was realizing he could separate the Trump brand from Trump business operations. When Trump-owned casinos failed, shareholders and creditors bore the losses. But the Trump name remained valuable enough to license to new projects. He essentially created a personal brand that was immune to his own business failures. Third, understand the difference between being bankrupt and looking bankrupt. In 1990, Trump was functionally broke, billions in debt, controlled by banks on a monthly allowance. But he never declared personal bankruptcy. He kept appearing publicly as a wealthy man. He maintained the appearance of success even during failure. This wasn't dishonesty. It was strategic image management. Fourth, recognize that American bankruptcy law is designed for second chances. Unlike many countries where business failure carries permanent social stigma, the U.S. system allows entrepreneurs to fail, restructure, and try again. This encourages risk-taking and innovation, but it also allows wealthy individuals to shift losses onto creditors while maintaining personal assets. Finally, and most importantly, in modern America, narrative often matters more than numbers. Trump lost $1 billion, paid zero taxes for years, and drove multiple companies into bankruptcy. Yet millions of Americans believed he was a brilliant businessman. Why? Because the story he told, the brand he built, was more compelling than the financial reality. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial educational mysteries.